This channel tends to focus on cryptocurrencies, but actually if we just look at crypto in isolation, we are missing the big picture. Traditional finance has more and more impact on Bitcoin, Ethereum and even the smaller altcoins, and the question is what's going to be a potential spillover effect that might be waiting for the crypto market coming from traditional finance. Because here's a chart most people have not seen before, a chart that's extremely important. This is the S&P 500, a very long term, starting in 1959, relative to the US money supply. So it shows us the price performance of stocks in a world where money is actually not debasing, where there's no Federal Reserve that prints money out of thin air. In that world, we've got stock markets falling by 74% over here and by 73% over here. And in that world also, it can take 36 years until we get our purchasing power back. Now that's quite interesting, right? When people say that it always makes sense to buy the dip in a stock market because the stock market will recover at some point. That is true measured in US dollars, but it's not necessarily true measured in just pure purchasing power when we compare the S&P 500 to just the amount of money that's floating around. This is a very long-term chart, right? This is 65 years of data and we are at an historical high here. This year was the dot-com crisis and subsequently this year the global financial crisis. The long-term average ratio is around here. So if we come back to the average, we'd see a drop of the S&P 500 by 47% relative to the money supply again. Now, why does this chart even matter for us crypto investors? It matters because there's more and more of a spillover effect. There's more and more correlation between the two asset classes. When crypto is going up, then stocks tend to go up as well, and vice versa. When we see a stock market crash, it's very unlikely that crypto will rally during such a crash. But the situation goes even further than this. This is the S&P 500 relative to the money supply. But have a look at the S&P 500. What's inside that index? At number 1, we've got Nvidia. Number 2 is Microsoft, then Apple, then Amazon, then Facebook, then Broadcom, then Google, then Tesla. 9 out of the top 10 shares of the S&P 500 are tech. If we sum up the weighting of all of those top 9 companies, we get to 35%. And so really buying the S&P 500 is more and more like buying the Nasdaq 100. Now this here is the Nasdaq 100 relative to the money supply again. And of course here the dot-com burst was way more severe than the global financial crisis. The Nasdaq underperformed money supply by 86%. Then afterwards we saw the global financial crisis. This was basically a deleveraging event in the property sector, but still it had an impact on technology stocks. Tech went down by 56% relative to money supply. And just have a look at the price right now. It's been 25 years since the dot-com bubble crash. And we are at very similar valuations yet one more time. Just as an exercise, here's the Nasdaq 100 relative to the S&P 500. And this chart again looks quite similar. We don't really see much of the global financial crisis here, but we can definitely see the dot-com bubble crash, and we can also see how long-term technology stocks tend to outperform other stocks because they are more risky and because the economy becomes more and more digital. Now, why am I talking about all of this? Does it mean just because the stock market is now historically expensive that we should sell all of our crypto? I don't think so, but I do think it warrants that we should have a diversifier. Besides just buying crypto, we should have something that is not correlated to our crypto portfolio. Some people think that they are diversifying away from crypto by buying Tesla stock or by buying Nvidia stock. But that's not true because there's too much correlation. When Bitcoin is crashing, then very likely we will see a crash in the tech stocks as well. I think the best diversifier is the asset that people buy during times of crisis. And what's the most obvious thing to buy in a crisis? It's of course precious metals, specifically gold. Have a look at this long-term chart here. This is the S&P 500. So again, the US stock market divided not by the money supply, but divided by the gold price. This chart has a very long history. It starts in 1884. So that's 140 years of data. And again, the dotted line is the average over all of those decades. And I just want to point out how much volatility there actually is in this chart. This was the Great Depression. stocks underperformed gold by 85%. Then we had the oil crisis, where stocks underperformed gold by 93%. And then we had .com plus global financial crisis, where stocks underperformed gold by 89%. So is Bitcoin, comparatively speaking, really that risky when we can see these kind of relative valuations for stocks as well? I'm not so sure, but let's come to Bitcoin in a second. The simple thing that I want to point out is that buying stocks is the best whenever nobody wants to get into them. When we've already crashed massively, that's when we can outperform just random gold holdings by more than 3,000%. What I also want to point out is that I think it's a myth that the stock market outperforms gold that significantly long term. Yes, we have seen some outperformance over those 140 years. It's 700%. But there is a lot of volatility in this. And there have been 100 years where we saw zero outperformance. But check this out. This is also close to 100 years. So a lot of that outperformance that we see here over those 140 years, it could just be volatility. It would at least be in the realm of historical volatility. And so maybe gold is just extremely cheap right now, relatively speaking, or stocks are that expensive. Let's have a look at other ratios. We know that stocks are expensive relative to the money supply. We also know that technology stocks specifically are expensive. And we know that stocks are expensive relative to gold as well. Technology stocks relative to gold still might have some upside. So this is 140%, but we are definitely above the historical average as well. But there is a case to be made that technology stocks should outperform gold long term because the economy, again, as said, is becoming more and more digital. And I don't think that this trend will turn around anytime soon. Now have a look at this chart here. This is the historical price to earnings ratio of the S&P 500. Whenever we buy stocks, what we're essentially doing is we buy the future earnings of a company. So when the price compared to those future earnings is very, very high, that means that stocks should be expensive. When the price is low, relative to the future earnings, stocks are cheap. This ratio is useful because we tend to trade in a range. Over the course of 100 years, we didn't see that ratio change much. But then something started with the advent of the personal computer, subsequently the internet. Prices tended to go up faster than earnings. And again, now we are at a price to earnings ratio of 39. In other words, it takes 39 years of the current earnings to pay for a company. This used to be at 6.6 years. Stocks are expensive relative to the money supply, they're expensive relative to gold, they're also expensive relative to the future earnings. Let's just work with the assumption that this PE ratio will come back down to somewhat normal levels, let's say 20, which is already quite high in the historical scale, but let's say we come down by 50% or so. That would bring the S&P 500 relative to the money supply back to its historical average. It would also bring the S&P 500 relative to gold close to the average, slightly below, but still within reasonable volatility. Getting into stocks has never been that speculative. The returns that we get with stocks have never been that low. And you might not be that interested in the stock market, but we will get the bridge to crypto in a second. This is the historical S&P 500 dividend yield. It used to be somewhere between 7 and 4%, and since the 1950s, this continues to decline. What does this mean when the dividend yield is only 1.2%? It's an expression that prices relative to whatever we get out of those stocks are very, very high. The dividend growth actually hasn't been that bad. It's at 7% per annum right now. But prices are simply appreciating much more than that. Here's the price to book value of the S&P 500 over the last 25 years. It's at an all-time high. And here's the price to sales ratio, right? If you think that maybe price to book is an outdated number because now we don't use as much machinery, we use technology, which is intangible, that's fair. But having the price to sales ratio that high is not necessarily that fair. This should be at a somewhat constant long-term equilibrium. It definitely is not a steal to buy at the all-time high when this ratio is so massive. Now let's finally get the link to crypto. Let's have a look at what happened with the stock market since Bitcoin was born, since it was invented. How did the stock market, say, relative to the money supply develop since then? And we've seen a lot of parallels between those different charts, right? S&P 500 to the money supply, to gold, etc. This here is when Bitcoin got born. The stock market relative to the money supply appreciated by 232%. Bitcoin never has seen a real crisis. It never survived a crash of the magnitude of the global financial crisis or of the dot-com bubble burst or of the oil crisis. We are at historical highs, and we can only speculate what's going to happen when a real crisis hits. We do not know. Some people say that Bitcoin is a hedge in times of crisis. Some people say that it also helps versus inflation. And while this is true to a degree, we do see a lot of correlation between the risk on assets and Bitcoin, at least in the short term. Once we see this massive crash, will Bitcoin really go up? Will it stay flat? Will it crash together with the stock market? It's very unclear. During short crashes, for example, the COVID correction, right? We see a one-on-one translation, as in, as the stock market is going down, crypto comes with it, with a leverage even. And so this is not pretty. It tells us two things. The first thing is that being heavily in stocks now is a bad idea. The second thing is that when currently the majority of your net worth is in crypto, you need to have some kind of risk management in place. There's all kinds of ways to manage risk, right? We can just manage the size, the allocation in a portfolio, not let this grow too much. We can use stop losses that we sell an asset in case it drops too much. We can also use diversification, as in we can buy assets that are not correlated to stocks and to crypto, so that in case we do see a major correction at some point, that we will have a hedge that might go up during that correction. And you might have guessed where I'm going with that. I believe that this ideal hedge is gold. Because have a look at another interesting ratio. This is the S&P 500 relative to the US GDP. It's a chart that starts in 1961. And does it really make sense that the S&P 500 is now 100% higher relative to the GDP compared to 1961? I don't think so. We see our regular crashes every now and then, and I do not know if we see another correction like this. I'm simply just seeing this long-term chart, and knowing that Bitcoin was created over here scares me a little bit. It tells me at least that we are in uncharted territory. Any kind of quantitative model that we have for Bitcoin, looking at Bitcoin's historical crashes, it might not encompass what could actually happen during a real contraction. And so really, the takeaway of this video is buy some gold. If you do not have gold at all, and you are 70, 80% in crypto, and your net worth is several years of your income, not just a few weeks or a few months, but you've got several years of wealth accumulated, and it's mainly in crypto, it's mainly in technology stocks, then please, please, at least allocate 10% of your net worth into gold. Have a look at the chart here below. This is the gold price relative to the monetary base. And when the S&P 500 relative to the GDP dropped by 75%, then the gold price relative to the money supply increased by 1,500%. Or let's say during times like this, right? Let's say we see a repetition of what happened with the dot-com bubble burst and the global financial crisis here. Had you just owned regular stocks, you would have underperformed the US GDP by 69%. Of course, relative to the money supply, it's even a bit more. But had you put at least some of your money into gold during that time, you would have outperformed the monetary base expansion by 645%. So more than a 7x return. So I'm not telling you to sell all your stocks. I'm not telling you to sell all your Bitcoin, because of course Bitcoin long-term tends to appreciate much more than the monetary debasement. So it does make sense to have a lot of money in Bitcoin or in crypto as a whole. The only thing that I'm saying is when you've got 10% of your net worth in gold, it will not kill your long-term performance that much. It's 10% after all, but it will rescue almost everything in case we do see the collapse. Then you will be one of the few survivors that made money with crypto, that made money with the stock market, that in the end keeps that money in a crash. And that has two positive effects. First of all, we don't get poor. That's a quite nice thing. But secondly, also it opens up opportunity, because then after the crash, we can buy the next assets very, very cheaply again. So we will be among the few that are able to pick up the pieces, that are actually able to buy the bottom. This quote-unquote insurance of buying gold is really not that expensive. Again, this is the gold price relative to the monetary base, and gold simply just kept pace with monetary expansion over the last 65 years. You really didn't lose much. But but we've got an incredibly great diversifier, an incredibly nice hedge that helps us survive in case we get into big trouble. Nobody knows if this happens. I don't try to think about this deterministically. I do not know if things will suddenly turn around for whatever black swan event. Be it some kind of global conflict, be it some kind of debt crisis in the US, be it whatever. I do not know what could be the trigger of a potential crash. It's a black swan event after all. But I do know that in case we do drop that heavily, that the stock market will bleed incredibly much. And I also don't know what Bitcoin will do during such a period, because again, we don't have that history yet. Bitcoin never lived through a real crisis. And during those minor crises, Bitcoin actually was not a good hedge. Again, Bitcoin had a COVID crash as well. It did not go up during COVID. It got up after COVID, once we saw the monetary debasement again. Now, there are several ways to go about this. If you're serious about the hedge, you buy physical gold. That's what I'm currently dollar cost averaging in. If you're lazy or if you want to keep your money on the blockchain, then there is PEX Gold. So this is an ERC20 token that tracks the gold price on the Ethereum chain. Of course, there's a bit of risk here, right? We don't know what happens during times of crisis, if then suddenly the government is going to tax gold holders, or if tokens like this suddenly become illegal. So that's why I have physical gold. But at least for price diversification, if you want to swap it very quickly, then PEX Gold is an alternative. And again, you don't need that much exposure. 10% of net worth, I think, is completely justifiable, especially if you're currently heavily in tech stocks, especially if you have a lot of crypto as well. It's a bit of a barbell strategy, as in we've got one part of our portfolio that generates all the gains, but we've got also another part of the portfolio that hedges everything in case things go really, really sour. I think it's actually okay to not own any stocks at all, besides the things that we have to own, say with a 401k. It's okay to just hold Bitcoin and have gold as a risk mitigation strategy. Across all ratios, stocks are simply super expensive, especially technology stocks. And we want to buy the things that historically are cheap, and we want to rather not own that much of the thing that historically is expensive. Now, I'm trying to be different on this channel compared to most other channels. Most other channels just say buy asset A or buy asset B and you will make a 10 or 100x return. But most of the time, most people just get wrecked in the process, because sometimes there's a conflict of interest, right? The influencer might already own the token, or the influencer might have even gotten paid by the project to talk about the token. But I try to do something different here. I'm trying to show that I'm not just talking, but I'm actually doing. So I opened a capital pool for the members of this community 1.5 months ago. And so far, this capital pool has an annualized performance of 79%. It started on July 10th and so far had only had a maximum drawdown of 2.3%. So that's what I'm actually most proud of, as in the gains are very, very constant, yet still very high. And the way to achieve those gains is by buying things like this. So this is a relative valuation chart. This is another relative valuation chart. Here is one more. And we're betting on one asset to do worse than the other. So this, for example, is WorldCoin. It's got an expanding token supply. Thus, it tends to underperform Ethereum. This is Ethereum relative to WorldCoin. Over here, we've got the token supply of DYDX. This is a decentralized perpetual futures exchange, also a growing supply. And then we see how Ethereum outperforms DYDX. Or over here, we've got the balancer token. I've talked about this for a long, long time on this channel. And here is Ethereum relative to balancer. So this is how we can achieve those very high returns by having very little volatility, very few drawdowns, because we cancel out the overall macro development. Yes, it's possible with crypto to double the capital just in a few months, but then also the risk is very different compared to what we are doing here. Because there are times where everything is going up, but there are also times where everything crashes, right? This is a long-term chart of Cardano. This was a crash of 97%. Then we saw a new all-time high, a subsequent crash of 92%. And that's always the problem with trying to chase the next altcoin. There's no protection against the macro environment turning around. But let's have a look again at those relative valuation charts. This again is Ethereum relative to balancer. And at the bottom, we now see the Bitcoin price. So Bitcoin Bitcoin went through an entire bear market, a 75% correction. But at the same time, this relative valuation trade still made money. Let's actually have a look at this on a logarithmic chart. Then we can see the percent changes a bit better. Just have a look at this, right? This is how we make constant gains without these massive drops. And I truly believe that this is the way to really make money in crypto. It's with relative valuation trades. It's just with figuring out, is A better than B or is B better than A? And cancel out the overall macro environment. We don't necessarily want to have too much exposure to the macro, because once we have too much volatility with our portfolio, then it's much harder to bet more capital. So think about this the other way around. Let's say we go for those moonshot bets, right? Let's say we want to make a 10 or 100x return. And let's say every now and then we're actually successful at doing so. The problem is very often those bets do not work out. Thus, we can't bet 10,000, 100,000 or even more dollars on such a bet. We have to do small bets and hope that among many of those bets, maybe one of them makes a multiple X returns. But that means we can't really invest a lot of capital. The lower our volatility is on an asset, the more we can potentially deploy, because then, at least mathematically, it's less risky. The less risk we have, the more we can deploy. The more risk we have, the more the risk of ruin, the more the risk of going down by 80 or 90%, the less we can invest. It's a bit like doing those very small bets, hoping for the best outcome, versus actual serious investing where we get nice compounding growth. And so yeah, there is this capital pool. The members get exactly this return right now. I don't just talk the talk, I'm actually showing the world openly how things perform in the open market. And I wonder if the other YouTubers that you're following are willing to do the same. And if they are, is the performance going to look like this? I followed this strategy of relative valuation bets for 4 years now, and because of that I got much more return compared to just buying and holding Bitcoin. Had I dollar cost averaged into Bitcoin, I would have gotten the return indicated here by this gray line. But because I entered relative valuation shorts, I got the return here in black. And so the community is following the strategy as well and sharing their gains over here in this chat. I'm of course sharing my trades as well. So this is July 23rd when I opened a short position on WorldCoin. So that's short WorldCoin and long Ethereum. And then a few days later, I closed it with some nice gains. This is just one example. My target with this community is not just to show how great the strategy works and how relative valuation bets is really where the alpha is. My target is not just to make money with that trading. My real target is to create a community where most members make money with the same approach as well. Of course, with the community capital pool, I also take a cut of 10% of the gains, but I think that's still comparatively fair because most other hedge funds, they take 20%, and at the same time, they also charge 2% of the entire principal every year. There's no such charge that I'm doing here for the members. The capital pool has been closed though, so the maximum deposit limit has been reached. There will be a new pool opening at the beginning of next year, but still, you can manually copy trade everything that I do. I share my trades in real time. And while everybody can share testimonials on websites, it can sound like it's cherry picked, right? Maybe the majority of people don't really make money with this. But that's why just today I asked the community members, has Premium helped you improve as an investor? And 87% said yes. Yes, I myself also voted with yes here, so make it maybe 86%. So of course, not everybody is happy. There are people that are still not able to make money. But I think 86, 87% is not too bad of a ratio. If you're willing to learn, if you're willing to follow the content, if you're willing to also implement the risk management strategies, then there's a very good chance that you will be among those 87% as well. I was thinking about this. How can I make this actually as easy as possible for new people to enter here? And what I thought is maybe I try to find an approach to make this with as little risk as possible. As in, I thought maybe there's simply just a bit of content that you have to watch first. Then I share my favorite trade that I have a lot of conviction in. And then after 1 month, if you don't make money with that trade, then I will just refund you the entire membership fee. So really, you don't have any risk with that membership fee. So here's what you have to do. You have to watch 2 videos only. It's how to bet on relative valuations by using perpetual futures on Hyperliquid, and then how to do risk management with relative valuation bets. Those 2 videos are just 1 hour in total. That's all the content you have to follow. Once you've done this, you join the community. So that's different channels on Telegram. And once you're in Telegram, then I will send you my favorite trade. Trades that look very similar to this and this and this, for the same reason, because of token inflation. That's why those tokens tend to do worse than Bitcoin, Ethereum, and Solana over time. And if you're not making money on a chart like this after 1 month of joining, then of course I'm willing to just refund everything. And with everything, I mean of course the membership fee, which is currently $125 per month. So this is now for the manual copy trading. This is now for learning how to actually make those bets. But if you're interested to be among the first people to join the next capital pool, which will launch at the beginning of 2026, that announcement will be made to the annual members. There will be an additional cost. It will not just be the annual membership, but the annual members will get early access. So feel free to change from monthly to annual if you don't have that much time, but you do have more capital. So that's more of a hands-off approach. If you have at least $10,000, better even more to invest in crypto. Then the annual membership might make sense long term. A link to Premium will pop up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in Premium. Cheers!